Well, we've enjoyed a very benign environment for quite some period of time. Low rates, equity markets are strong, credit markets are equally strong, plenty of money floating around, borrowers are dictating terms. Uh, Argentina just issued a 100-year bond, and people forget that they just defaulted only in 2001 on their debt. So volatility is at a real low, spreads are at a trough. So you put all this together and you wonder how long can this last? The business cycle has had about a 9-year expansion. We're into the 9th year today. The longest business expansion has been, I think, 13 years. So at some point this is going to turn. Now when it turns, is it going to be a crisis and something bad really happens? I really don't know. But that's kind of what we need to be prepared for. We can't just assume that this benign environment continues forever. Now, having said that, we've been talking about rates have only one way to go and up for the last 3 or 4 years, and it hasn't happened yet. So maybe this will continue for some period of time, but at some point I think it'll change. I hope that it changes at a gradual pace so that we're not confronted with sort of real structural issues. Yeah, I assume you're talking about kind of investing cash off the balance sheet of companies. Most of us invest in investment grade risk, pretty much LIBOR-based short-term returns, sometimes longer duration portfolios. And there's no free lunch. There's no running away from the fact that interest rates are low, and unless you take risks, you can't improve those returns. And those risks go outside typical corporate investment guidelines. So what we do in our managing our portfolios is that we look for arbitrage opportunities. For instance, our US dollar portfolio has a fair amount, I would say about 20 to 25% of our investments are in foreign currency bonds, from anything from euros to Swiss franc to Israeli shekel to Czech krona. And we do that because we find that the currency swap has spreads offer us an arbitrage into US dollars. So had we just invested in US dollars, we might have got LIBOR or LIBOR plus 10 or 20. By investing in these foreign currencies and swapping to US dollars, we get another 20 or 30 basis point pickup. And that has been a significant portion of what we've been doing. The other thing we've been doing is that banks have a bunch of regulatory issues about the kind of capital that they need, and they primarily need somewhat longer term capital. And we've been able to structure repo transactions that run a year or more, but which have put options that enable us to put those bonds back, put those instruments back to them at, say, 30 or 60 or 90-day notice. So it kind of is a short-term instrument for us, but it is seen by the bank regulators as a longer-term instrument, which kind of helps them. So they're willing to pay 30, 40 basis point premium sometimes in those cases. We do other things in the US which may not be completely applicable here, like we invest in transactions where the risk looks like a investment grade risk, but the return comes mostly from tax credits in solar projects or similar, and the returns are outsized compared to LIBOR. So we look everywhere for interesting opportunities, but without violating our risk guidelines. Well, I think the first thing we could do is to take a look at our portfolios of assets and debt and make sure that asset liabilities are well matched and that the exposure is as minimal as possible to rate increases. The other thing one can do is look at your financing needs over the next several months or a couple of years, and try to go to markets, particularly since markets are receptive, and borrow the money before rates go up. In some areas, rates going up is kind of beneficial. Pension liabilities, for instance. I mean, as rates go up, the mark-to-market on that sort of makes that a smaller liability. And when that happens, perhaps one should look to take advantage of liquidating those liabilities in some form or another. So these are some of the things that I would suggest.